trend assumptions about the dollar, that they've gotten excessive, and when it snaps, that's when you'll see gold snap the other way. And I think that's what gold is watching primarily right now. There was an article in the Wall Street Journal yesterday. I suggest everybody get it. It's in the business section, lower half of the business section of the Wall Street Journal. An article about emerging markets and how they're being stressed, some to the point of near collapse financially by the strong dollar. You have to realize that in Europe and in lesser countries around the world, strong dollar is hurting them in terms of their ability to buy essential foods, energy, and so forth. It's going up for them because their currencies are going down relative to the dollar. The Fed likes to act like they're looking at all the data points that are domestic. Okay, so their job is to protect one, restrain inflation here, but two, the other side of the equation is to protect the unemployment situation. But they casually dismiss that as, oh, we got no problem there. Okay, well, if you look at the unemployment and the employment numbers and find out who's being hired where, you'll see it really is in sort of the the leisure industry is where a lot of the hiring is occurring. And those numbers, by the way, can change drastically and quickly, like a light switch. So anybody who assumes you look at the data from last month and you've got a reality check, no, you don't. Okay. First off, we know that Europe is probably in a recession. They're being choked by high energy prices to the point of where they have to shut down, cities at certain points in time of the night, and factories are cutting back in production. And China's now admitting very bad economic numbers. And if their government's admitting bad economic numbers, you can bet the numbers are worse than what they're admitting. Okay, so you have two of the major economies in the world, Europe and China, let's call it in recession or beginning to enter recession. It's argued that Europe's already in one, period. Bank of America claims that the U.S. is already in the second quarter of recession anyway, despite what the government claims. And, a sober outlook there from them. And also from JP Morgan. They've come out with highly negative comments about what's coming. But the Fed's all happy, they're gonna curtail inflation and so forth. The problem is the 4X issue, because it is choking Europe in terms of the cost of what their euro can buy in terms of energy and so forth, which the comparisons are stark versus us. If they go into recession and China goes into recession, we're going too. You can chatter all you want to about a good-looking unemployment number. Listen to Biden talk about how things are looking rosy and it's the best in decades. We'll go down real quick. We're not going to be isolated. So anybody who thinks that you just look at our data points is making a mistake. But this dollar issue is far more acute for some emerging market countries, including some major emerging market countries. And I suggest you read that article in the journal. I'm not going to go into it here except to say that it did point out a feature that we have technical reason to assume is the next major pivotal explosion point in the marketplaces. That's the dollar. And when I say explosion, I mean implosion. Back in 1987, before I ever established momentum structural analysis, I was a futures broker from 1975 through 1992. As it happened, I caught the crash in 87, and I caught it because I was running quarterly momentum of the S&P 500, meaning I'd run every monthly bar and plot it in relationship to its three-quarter moving average on an oscillator, not just overlaying it on a price chart. You look at a price chart, you had this upward trending market. Naturally, all bull markets look that way. But on a momentum chart, you had a floor. It was being repeatedly hit and hit and hit. They kept buying it at a certain level relative to that three-quarter average. So I saw a structure that said, oh my gosh, when momentum builds a structure that is so obvious as that, it's like when a price chart builds a structure that becomes so obvious that everybody can see it. Well, that doesn't matter so much as when momentum does it. Because momentum builds a structure, it's going to use it. It's not there to ultimately be used as repeated support forever. It's going to break that support. The more it's used, that structure, the riper that structure is for an implosion, for something more and more dramatic, the more times it used it. The dollar index, which is largely, we know, 57% euro and 17% yen, so it's largely those two currencies. But when I technically analyze the dollar index on a quarterly basis or versus a three-quarter moving average, or versus the 3-month moving average, which is like an intermediate trend metric. Both of those momentum charts jump off the page at me and say, you're going to break down. And when you do, you're breaking a structure that is enormous. In fact, on the monthly oscillator, we've spent 13, I think we're now into the 14th month of living above the 3-month average. It doesn't inhale. I mean, it inhales only, it won't exhale. Markets normally breathe. The dollar index has lived on this floor, and it's developed, therefore, a momentum structure. And when you go back down and you tap that structure again, I would bet on the dollar imploding rapidly. There's a reason why the central banks probably, or the Fed might like to see some kind of pullback in the dollar occur, because they are jeopardizing the fiscal and financial status of a lot of these significant developed economies, emerging economies, excuse me, and it also hurting Europe badly in terms of their ability to buy energy. So, though they never discuss the issue, Powell never mentions the dollar. He did not today. It really is an issue in the back office, because I have no doubt that the central bank heads of Japan, Europe, and the US have been on the phone about that issue. And there's some point where that dollar is a killer, because it's going to help drive those economies into a recession and worse if it doesn't stop. Now, because of the investor excess and sentiment, and I don't just mean common day investors, I'm talking about corporations, countries that have committed to the obvious trend of the strong dollar, 20-year highs. Actually, if you stand back and look at 50 years of data, it's pretty unimpressive. The 20-year highs is from a very shallow range. But anyway, the point being that it is choking a lot of economies, and therefore it is an issue that the central banks will have to address. Recall back in 1998 where the Thai baht currency collapsed. Also, the Russian ruble had some problem. Here Thailand, okay? The market collapsed in 1998. They had to come in and bail out one of the largest hedge funds in the world. The Fed had to effectively buy it. If you recall, Greenspan was in charge then. That was just the Thai baht. What happens with Egypt and with some of these other larger developing economies that are, again, read that article, that are being stressed badly? What we're dealing with here are central banks that could go under, large banks that could go under, and make headlines that would suddenly hit a light switch that people aren't even thinking about right now. So our focus is on the dollar index right now, and I think that's one of the reasons why gold is not collapsing. Yes, gold is weak today, but remember, it's been in a 2-year range with lows 3 times in the 1670s, highs above 2000. We recently got back to that low, and we didn't break it. Somebody bought it again, drove it up to 1800. Right now we're trading about 1750. How come gold's not collapsing? How come it's down on the year 5-6% with the S&P's down, double digit? Everything's down double digit, especially today. And gold is not falling apart. I think gold knows that, if you look at a chart of gold versus the euro, gold versus other currencies, it's very strong. Against the dollar is the only one where you've got this range. And I think the dollar gold understands. There's some investors in gold understand that there's this problem out here about the dollar that can't be allowed to persist, because if it does, it will collapse so many things. Therefore, some kind of policy change has to occur. Maybe it's behind back closed doors, but something has to occur in terms of causing this excessive investor flood into the dollar, which has been overdone, technically speaking. And whenever you get a market that gets overdone one way, usually when it snaps, it goes farther the other way than it might otherwise. So I think the focus right now for investors should be the dollar index. Right now it's trading in the high 108s. It's been over 109. Our metrics say that starting next month, just 4 or 5 trading days from now, you get down around 106, it's over. Now today's low is like 107.50. Okay. So, a couple points below where you're trading right now on the dollar index next month. And we argue, and we provide specific numbers in our reports to our subscribers. But basically down around that level, we think the floor is coming out. And it could be sudden, where we could see the dollar go from 108 plus now to 106 to suddenly it's at 100. and it occurred within a matter of a couple of months. A very dramatic situation, in part because of the crisis situation that's been built up fundamentally, and secondly because of the excess investor and corporation and government trend assumptions about the dollar, that they've gotten excessive, and when it snaps, that's when you'll see gold snap the other way. And I think that's what gold is watching primarily right now. They invariably do, and I think they'll come out of a slingshot hole. Yes, they're underperforming gold. They always do. When gold goes down, they go down more. When gold goes up, they go up more. Okay, that's just a general rule. And I'm talking percentage dynamics. The same is true with silver. And one metric we're watching there very closely, in fact, we're watching it week by bloody week, is the silver-gold spread. There are some numbers not far above where the spread is right now that would tell us that the spread is shifting toward favoring silver. And when we see that breakout on momentum of that spread, not the spread itself, we're measuring it on a momentum chart. There's a ceiling on a 10-week average oscillator of the silver-gold spread. Sounds kind of obtuse or obscure there. But there's a ceiling structure on that goes back like a year and a half, where every time you get the momentum readings up to a given level, they crest. So you've created a structure, a ceiling, and it's shallow. So it won't take much if that spread upticks just a little bit from where it is now. And again, we measure Friday closes versus Friday closes of gold versus silver. Silver's going to break out on momentum, and every time it does that, it usually leads to not just an outperformance of silver versus gold going forward, but an actual net price increase in both metals, with silver at the forefront. So that's another metric we're watching very closely in terms of defining the definite upturn in the metals. Not merely that they're holding some given level like gold has, but they're actually going to turn up and make a move through the highs. And we need that silver-gold spread to break out, and I think it's likely to do so. It's just a matter of which week in the coming weeks will it signal that for us.